right, welcome. We're back between two fiduciaries. Jimmy, how you doing
I
today?
am great, Jeremy. How are you?
Doing really well, thank you. So today we're talking about market corrections, and this is an important thing. We've just come through another market correction, and we're going to dive into that, give you all the details. The market has since come back a little bit since that correction last week,
Right.
but we think this is really relevant material.
Absolutely.
So happy 103rd market correction. Is that something we should be celebrating? I'm not sure.
Yeah, right. It's a bit of a catch-22, but the debate over are these healthy? Are they good? We'll get into the details here, but 103 that's a big number.
It is. It's a lot of them. And so I think what that tells you is these things do happen more often than what people maybe want to admit or even know.
Absolutely.
So what are they? A market correction is something it's there's a little bit of debate around, where do you take the data points, but if you look at it from a simple perspective, it's 10% off the most recent highs.
That's exactly right. 10% is your correction.
So the last market correction was in September of 22. And here we are now in November of 23.
Yep.
So again, we're going to get into this. Are they good? Are they bad?
Right.
So here's a nice slide that talks about what happens after those market corrections take place. Do they lead to bear markets? Talk to me about bear markets real quick. What are they?
Yeah, so a quick important differentiation here. So corrections, as you laid out before, are a 10% decline from the previous high. A bear market is categorized as a 20% decline. So important to understand that the difference between the two. And what's really interesting to see in this chart here is that this goes all the way back from 1974 through 2020. So this is not up to 2023, but through 2020, you had what do we have here? 5 market corrections that have turned into bear markets. So of those 10% corrections, only 5 times in that 46-year time period did we have a market that dropped over 20%.
Right. And so if you kind of fast forward where this slide drops off, 2022 was a bear market year.
Yep.
It lasted a pretty long period of time.
Right.
But that would have made, a sixth bear market in then 49 years.
Right.
Okay. So those are the facts. Those are the figures. It is what it is.
Right.
So now let's talk about that concept of the bears versus the bulls. Which one has greater staying power, and what does that look like?
Right. So, I think what you see here, the bull markets are colored in blue here, the bear in the red. And what you can pretty quickly gather from looking at this is that there's more blue on the screen than there is red.
Right.
And so I think, to say this more succinctly, like the U.S. stock market has been a story of longer summers and shorter winters.
Mm-hmm.
And the corrections, although they hurt, and the bear markets they hurt even more. The reality of the situation is there are a lot more bull markets. They last a lot longer, and the amount of increase off of the bottoms is quite a bit more than what the declines have been historically.
Yeah, and I think it's always important to put that context of history into these equations. There's been a lot of historically crazy times since 1966.
Oh yeah,
a lot of things have happened, and yet the market still proceeds to push forward in many ways. Again, sometimes doing so in a painful way. It's that difference between, and we've talked about this a lot, between zooming in on that chart and looking at it on a day-to-day basis and saying, boy, that looks manic, and then zooming out and going, wow, that looks pretty clean.
Well, it's always easy at any point in time to find reason to be concerned with the stock market, right? Whether it's geopolitical risk, whether it's inflation risk, whatever is the risk of the day. It's easy for somebody to come up with why they should be, concerned with the stock market conditions. But again, when you look back historically and you think about all the different events that have happened in these different years, if you were not invested in the market, you've cost yourself quite a bit of potential for return.
You have, and so there's what would you say to somebody who comes to you and says, boy, the market looks like it's really a dangerous spot right now, and you would maybe even agree with that with them in that point in time, and they say, Jimmy, should we be going to all cash, or should I be dumping my equities right now and really changing my allocation?
Well, it's a great question. The answer is no, right? I mean, now, under the context of you need to build a financial plan to understand what the proper asset allocation is, but going to all cash is almost never the right answer. And what isn't captured in this chart here, and we've looked at this before, but these bull markets, when we start to rebound off the bottom of a correction or a bear market, those first few trading days after the end or the bottom of the bear market are where you're going to get a vast majority of the return. And so if you're trying to time this and get out of the market and be in all cash, and you want to get back in once things look good, well, you've likely already missed a substantial chunk of what the initial bounce in that bull market. And so,
Right.
is that a head fake, as they'd say? Is a initial bounce, is this going to be a head fake and we're going to go back down, or is this something that has sustained power to grow forward? And if you aren't participating in that in the beginning, your returns look a lot more muted in the long run.
Yeah, and I'll add to that and say, and these numbers are going to be directionally correct, but if you look at that bull market that we've had here most recently, call it from 2010 through 2020, there's a 400% increase in there. There was there was almost 4,000 days there.
Right.
Okay.
Yeah.
And I think there's something to the effect of 30 or 40 of those days make up the vast majority of that 401%
Right.
increase.
Yeah.
Again, where those play out, how they're going to play out, if you're changing your allocation, getting in and out, it's impossible to time that.
And who felt comfortable investing in the stock market in March of 2009?
Not a whole lot of folks.
Not a lot.
Not a whole lot of folks. But for those who were brave enough and hardy enough, they were rewarded, and that's the point.
Absolutely.
Well, that's all we have today. Thanks again for another round of the Two Fiduciaries. We'll see everybody soon.